Hello, everybody. Happy Thursday. How's everybody doing today? So we're going to be going over basically a general overview of the market and what can we expect from 2025. There's a lot of exciting changes happening, and there's a lot of new things that we're going to have to deal with, especially in Pennsylvania for 2025. There is, we had elections, the Fed has met, a lot of things have happened since the last time we talked. So I have a presentation prepared. I'm just looking for it right now, and I will put that up on the screen. But basically, we're going to talk about how the bond yields affect interest rates, how the Fed has been cutting rates, but mortgage rates are still rising, what 2025 might look like for the real estate market, what Pennsylvania specifically will look like, and how we're approaching the market in 2025, and so on and so forth. We also will take questions and do, a short discussion if anybody is interested in doing that. But to start, I will share my screen here. Bam. So we're going to do a housing overview for 2025. This is put together by House Buying Solutions and Osmenic. House Buying Solutions is our house buying company, so we buy houses cash, as is in Northeast Pennsylvania. We also provide apartments and affordable housing through the Osmenic organization, our parent company. To get into this, I do want to disclaim that I may have a financial interest in the businesses or assets discussed. However, this content is intended for educational purposes only and does not constitute investment advice. Furthermore, it is not an offer by any of my companies to invest. So to start, I wanted to go over days on market. So we're currently in winter. It is December in Northeast Pennsylvania, and it gets cold. Not only does it get cold, but we have a lot of holidays. So what does this mean for real estate around this time? So as you can see here, this is from the Fed. And hey, Michael, it's good to see you. Thanks for joining. So this chart is from the Fed, and it tracks days on market in Northeast Pennsylvania, specifically the Scranton, Wilkes-Barre, Hazleton, CBSA. So as you can see here, we have data going back into the end of 2016, entering 2017, January, and you can see that going into January, days on market back in 2017 went from 80 days on market average to all the way to 110 days on market. So you had a massive increase this year in 2017 around January. And then you see as we approach July, so May, June, July, you start seeing that days on market come way down. And then again, you see the same exact thing for January 2018. And then you see days on market come way down in July 2018. And then again, January 2019, January 2020, and then January 2021. So we can see in January 2020 that there was actually a spike again in July. And if you remember this, if you were in real estate at the time, so I bought a property in March of 2020. And I remember in Pennsylvania, so when I bought this property in March of 2020, people were afraid to let you in their house, right? This was the beginning of the pandemic, and people were afraid. Like they thought it might kill them. Nobody knew what it was yet or anything. So we had this massive uh, decline for a short period of time when the pandemic first hit. And I was still out there buying. And I remember, a lot of people didn't want to show their house, right? And if somebody was selling a rental property, the tenants were like, no one's coming in here. So I remember walking properties with my agent who was pregnant at the time, going through these houses. Man, she was great because like literally we were going through a pandemic. She was like 8 months pregnant. It was raining, it was like crappy weather. And she was showing me all these properties. And I bought one in March, and I got a really good deal on it because of this dip. Ooh, let me add it back to the stage here. So this dip that I'm talking about. So you see like January 2020, massive drop off, and then it spiked back up. This is when the pandemic hit. And right around in March is when I bought. But you can see the days on market goes way back up and then drops again in July. And then the market gets crazy. And then our average days on market goes down in general from 2020 all the way until now. So as you can see, the trend continues with January 2021 with days on market spiking on the winter time. Oop, I just accidentally went to the next slide. And then January 2022, another spike. January 2023, another spike. January 2024, another spike. So you can imagine that January 2025 will be the same. So why am I talking about this? So as a flipper, as somebody that's looking to buy, this is the best time to buy. So in these peaks and troughs, this trough is probably not the best time to buy, but this peak, this is when people are motivated. So the property is sitting on the market. It's the middle of winter. It's around all the holidays. Your competition and your demand for housing drops significantly because people are more focused on the holidays. So let me repeat that just one more time. Your competition and the people in the market looking for housing around holiday time drops significantly. So this is your opportunity if you're a first-time home buyer or if you're looking to get your first investment. I would say buy when everyone else is focused on the holidays. You can focus on looking for a deal. And you're going to have higher days on market, so you're going to have more negotiation power when you bid on that deal. Like, it's a lot harder to get a deal when there's 15 other people bidding on it. And if you get this opportunity in December when everyone is worried about Christmas and New Year's, then you should probably take it. And then for flippers, this is something to pay attention to when you're getting ready to list your flip. So if you complete a renovation, and I'll be honest, guys, like a lot of people don't share their losses and stuff like that. Last winter, I lost money on 2 flips. I don't know how much. I maybe broke even or whatever, but like breaking even is like losing money to me because we put a lot of time and effort into it. So we lost time and effort. So that's money. So anyway, I assume that we basically lost money on 2 flips last year because it was winter. Nobody was buying. We listed them beginning of December, then the holidays hit, and nobody bought them. So we lost money on 2 flips last winter. So flippers, this is something to pay attention to because if you list your flip beginning of December, you're not going to have as many eyeballs on it as if you waited until after January. So anymore, we wait until after January to list our flips. And this chart is exactly why. So if we go into the next slide, we can also compare I wanted to draw some comparisons. So I wanted to look at Pennsylvania, and then I also wanted to look at Florida, right? Because Florida is nice in the winter for the most part. It stays pretty warm. And people that are fed up with Pennsylvania or fed up with the Northeast, they might think about moving to Florida during the winter. I would assume this is the busiest time for Florida, right? But no, the data does not show that. So if we look at this chart here, it's a pretty similar pattern to Pennsylvania. Now, of course, like this market is a lot more active. There's a lot more volume than the Scranton-Wilkes-Barre market. But you can see even in Florida, in Tampa, Florida, the days on market goes up around holiday season. So January 2017, days on market spikes from 55 days up to 65. And then we see the same thing for January of 2018. We see the same thing for January of 2019. Oops. We see the same thing for January of 2020. And we see the same exact behavior that happened in Pennsylvania. And then we see the same thing in January 2021, 2022, 2023, and 2024. And notice on this chart, so one of the things, look at this. So the days on market in Pennsylvania, in Northeast Pennsylvania, the days on market has significantly decreased on average. So the support and resistance levels of this chart, so the support level would be the bottom line, right? So this is like the bottom, this is the support. That's like a technical analysis stock term. And then the resistance is the top, right? So the theory is that your support and your resistance, there's like bottoms and tops, right? And as you can see, the support and resistance continues to get lower for Northeast Pennsylvania. So our average days on market in general, whether it's winter or summer, is going down. And if you look at Florida, it is going up. on average. So comparatively to 2017, we're now above, starting in 2017, we're at 55 days on market. The end of 2024 or July 2024, we're at 70 days on market. So Florida, days on market is going up dramatically. Whereas the Northeast, we still are having low days on market. So these are some of the things that I wanted to look at and I wanted to talk about today. Because when I do these presentations, it's not only just to make content and to tell other people about stuff, but it's also so I can learn. What I found is when I make these presentations and when I talk about the things that I'm studying, it helps me to learn them better. And it helps me to make better decisions when I am investing money, whether that's my money or other people's. And doing this research and being able to talk about it, it really sticks in your head more. So that's why I do these. And if you're watching right now, you're getting the benefit of me trying to educate myself, because this is how I do it. So I look at the days on market all the time because I'm flipping, I'm buying a lot of property. I want to make sure that I don't lose money. What's rule number one in investing? So rule number one in investing is do not lose money. Rule number two of investing, do not forget rule one. That's it. Like, you don't have to buy something. You don't have to do anything. The biggest thing is don't lose money. It's not about making all the right decisions. It's about not making the bad decisions, about avoiding the mistakes. That's all it is. So we want to know what's going on in markets and we want to compare it to other markets to see how our market is faring. So that's basically why I'm comparing Northeast Pennsylvania to Florida. So we can see that days on market is going up a lot in the Tampa, Florida area, whereas in Pennsylvania, in Northeast Pennsylvania specifically, days on market has continued to stay low with those spikes around the holiday. So if you're flipping, if you're about to list a house, the winter is a tough time and the holidays is a tough time. Now, if you're trying to buy a house, this is your opportunity. So those are my two pieces of advice. Flippers, hold off. And buyers, this is your chance. The holiday season is when days on market goes the highest because there's the least amount of shoppers. It's all about supply and demand, right? So let's draw down a little bit more on the Scranton, PA housing market. I am solely focused on Pennsylvania. I don't do any deals anywhere else. I just completely focus on Northeast Pennsylvania. This is my little corner of the world that I can get a really good understanding of. And there's no way that I can get a better understanding of it by being in different markets. I need to focus all my attention on this. So we're going to talk about Scranton, PA a little bit, and we're going to compare it to some other markets. So Scranton, PA housing market, this is from Redfin. And so the Scranton, PA market in October 2024, Scranton home prices were up 8.8% compared to last year, selling for a median price of $180K. On average, Scranton homes sell after 25 days on the market compared to 21 days last year. So the days on market has went up a tiny bit, plus 4 days on market that this chart is telling us. But the price has went up by 8%. And you could see over the last 5 years here, the days on market compared to our Fed chart, right? This is Redfin data. You can see that the days on market has significantly went down on average, and we have those spikes. So it's confirmed in multiple data locations. Let's pull up this other data source real quick. This is Realtor, because I think this actually might be a little bit more accurate of what's going on in Scranton, PA. So Scranton, PA, median list price, this is saying, is approximately $198,000 or $123 a square foot. I would say that's about right. $123 a square foot is what we look to sell things at. $110, $130 a square foot, depending on the neighborhood and the product that we're delivering. So we can see here that in October 2024, the median listing home price in Scranton was $198K, trending up 11% year over year. The median listing home price per square foot was $123. So Scranton is going crazy, right? There's a lot going on in Scranton and the Northeast in general. It's very interesting to watch. And Florida is suffering really bad right now. So I wonder if it's just, this last bastion of affordability where people are just really seeking affordable housing, and so they're running up the prices. Another thing to note is that the Northeast is typically 1 year behind. So whatever Florida or California is experiencing today in the real estate market, it seems like when you look at the data that the Northeast experiences that a year later. I'm also going to look at Bloomsburg real quick. So in October 2024, Bloomsburg. So one of the things that we want to do is like every market is so different in real estate, right? You have a tertiary market, you have your primary markets, and I wanted to look at, does a tertiary market fall before a primary market? Is a tertiary market less stable, more stable? And, what does a tertiary market typically perform? And every tertiary market is different, is what I found. But we can look at Bloomsburg, which is another place I'm invested in. I'm currently selling a 20-unit building. We're under contract. We're supposed to close December 31st. So Bloomsburg, PA, in October 2024, Bloomsburg home prices were up 4% compared to last year, selling for a median price of $195,000. On average, homes in Bloomsburg sell after 63 days on the market compared to 60 days last year. There were 8 homes sold in October this year, up from 6 last year. So Bloomsburg, PA, the days on market is normal. Like it hasn't seen this massive demand where the days on market completely dips to levels that we've never seen before, right? So this is a tertiary market, and Bloomsburg is kind of just doing its own thing, right? It's so different than Tampa. It's so different than Scranton, and we can see that here. And just to click on another, because we want to make sure that the data we're looking at is correct, right? So you have to check multiple sources. So this is Realtor. So we used Fed data, we used Realtor, and we used Redfin. And like the Fed uses Redfin, so or Realtor data sometimes. So the median list price in Bloomsburg is $270K. The median listing home price per square foot is $147, according to Realtor, and that is up 24%. So home prices are up 24% in Bloomsburg, PA. The median listing home price per square foot is $147, and the median home sold price was $240K, up 24% in Bloomsburg. That's crazy. So now we're going to hop back over to our slides, and we're going to continue to review market. So this is Pennsylvania in general. So we're going to look at Pennsylvania in general because we looked at a primary market, we looked at a tertiary market. Now we're going to look at the overview. So Pennsylvania is doing well still. The Northeast is still doing well. Home prices in Pennsylvania were up 8.8% year over year in October. At the same time, the number of homes sold rose 5.1%, and the number of homes for sale rose 6.9%. So inventory is going up, but the number of homes sold is going up, and the price is still going up. So there's still a lot of buyers in the market. And you can see this roller coaster line during the holidays here too. It's reflected here as well. But the days on market is going up. Now, is that a consequence of the holidays, or is this going to maintain and be something a little bit longer like it is in Florida? And we're just going to go to another source really fast. So Rocket Homes is saying that this is still a seller's market in Pennsylvania, and the median home price is $315K at $183 a square foot, up 15% year over year, according to Rocket Mortgage. Now, we can look at a longer view of Pennsylvania days on market. We can see that 2017 to 2024, it's basically maintained the same exact pattern as Scranton, as Bloomsburg, and even as Florida, right? Just people do not want to buy during the holidays. People have better things to do than look at real estate, I guess. Not me, than try to buy a house. So that's what we're seeing reflecting in the data basically everywhere, and that's what we're seeing in Pennsylvania, and it's a known thing. So let's look at another tertiary market of Pennsylvania, because we want to see, like, okay, once the market starts to drop, because the market goes like this, all the time, right? It's always up and down. I would never assume everything to just like we buy because it makes sense now on our numbers, and we buy with contingencies and with conservative like approaches. We have built-in mistakes, like a margin for mistake, right? Or a margin for decline. So when we make an offer, we have that margin of decline in there because the market can flip any season, right? Any quarter, the market can flip. So Nanacoke is a tertiary market of Scranton. So right outside of Wilkes-Barre, Scranton, you have Nanacoke, Plymouth, and a bunch of other older coal towns. So as you can see in Nanacoke, the days on market was up around 300 days on market in Nanacoke, Pennsylvania before the pandemic, right? And then the pandemic hits and you see the days on market go below 100. And then you see as Scranton gets crazy, so do the tertiary markets, right? So it seems like when a primary market goes big, a tertiary market follows. I'm just going to move this TV because it's actually distracting me. So the tertiary markets typically go up when a primary market goes up as well. Now, Nanacoke is declining. The days on market, the data doesn't look as good, right? Days on market is up 38 days year over year. The number of homes sold is down 9%, and the median sale price is down 23%. So that's, this tertiary market is suffering. Is that a sign of what's to come in the primary market? We can look at another data source. So the home values in Nanacoke, median list price $160K, median listing home price per square foot $100. And this is still a seller's market, they're saying. So homes on average sold for 3.92% below asking price in October. Median days on market is 24 days, which is still really good, right? If you look at the beginning of Nanacoke, the days on market was over 300 days. That was the average days on market coming out of the winter of 2019. So we're still doing really good in Nanacoke. Does that continue? So now let's get into mortgage rates, because real estate uses leverage. Most buyers that are buying real estate are using leverage, and oftentimes it's 80% leverage or 75% leverage. It's usually more than 50% leverage that you're using on a real estate deal to purchase it. So leverage and interest rates have a massive impact on real estate. So we've been tracking mortgage rates basically since I've started going live. So the last few months, I took a month off. The last presentation I did was September. So there's been some developments since then. So mortgage rates are going up, right? Mortgage rates are going up even though the Fed has been cutting. So the Fed cut September 19, 2024, 50 basis points, and then they cut November 7th, another 25 basis points. But mortgage rates have actually went up since then. So why is that happening? So I've explained this before, but the Fed funds rate is basically the overnight lending rate that banks have to have a reserve balance when they close at night. And if they don't meet that balance, they have to get it from the reserve bank, right? So they're paying interest on that money overnight. And so it affects their operating costs. It hurts their margin. And it's more expensive for them to operate the higher the Fed funds rate is. So the theory is that if your Fed fund rate is lower, the bank can save on operational costs and pass those savings on to the customers. And then also in correlation with the bond yields, like a lot of investors are choosing between bonds and mortgage-backed securities. So banks typically want a spread on bonds. So if bonds are yielding 4%, banks want to put 2% on top of that so they make a profit, right? Because they can borrow the money at 4%, they want to make a 2% profit to cover their operating costs. So when their operating costs go down, they should pass that savings on to the customer. But that has not been happening since the Fed has cut rates, right? We have had a 0.41% change, 41 basis point change over the last year. And over the last week, since the Fed's cut rates, we have seen rates come down a little bit. But if we look back in in September when we were covering these rates, we can see that the rate was lower back in September, right? So the rate has actually risen by a decent amount since September. And before the cut in September, rates were down already. So the market had it pre-priced in. As you can see, the 1 week change back then was 0.11, and the 1 year change was a whole percentage point. And the 15-year was 5.15. So now going back to today, even though the Fed has been cutting rates, we are still seeing higher mortgage rates, significantly higher mortgage rates. So what does this mean? So this means that investors are demanding a higher yield because they think that inflation is coming. So but before we get into that, let's track more of what rates have been in the past and what they could be, right? So this is from Freddie Mac. This is data from Freddie Mac, rates since 1969. And as you can see here, starting in 1969, we were at about 7.5%. We went through the 70s, which included, an oil embargo, war in the Middle East, heavy inflation, gas shortages, and you can see the recession lines when those things happened. And rates continually went up. Like the Fed would cut rates and then they would raise rates again because inflation didn't go away. And then this didn't stop until Paul Volcker came in the late 70s, early 80s, and he finally raised the Fed's funds rate to over 14%. And mortgage rates shot up all the way up to over 20% in some cases. And then Reagan came in and he created massive tax incentives for investors to stimulate housing. So from the height of interest rates, mortgage rates of about 20% back in 82, we see the steady decline back to a more normal rate. So the Fed is trying to stop inflation. We're going to get into what the Fed talked about, but first, let's just analyze this chart fully. So, yeah, I mean, we can see that historically, the rates that we're currently at aren't that bad, right? Like, I mean, historically, these seem pretty good. If you were to draw a line right here, let's see if I can draw a line. I can't. I might be able to, but I'm not sure. Anyway, so rates right now are pretty similar or average to what they've been in the past. And me personally, I don't think they need to go lower. But there's a lot of bad debt out there. And if they don't go lower, that bad debt needs to get deleveraged. So, as we can see here, mortgage rates have been really low and we had the massive spike. And now we've been up and down as the market tries to figure out what it's going to do. Next slide. I should have put this in the beginning, but this is the personal savings rate. So this is another thing to pay attention to. The personal savings rate is how much money regular people like you and I, are saving that they have in their bank account. How much money do people have in their bank account? So that's the personal savings rate. So you can see here, the personal savings rate has maintained a pretty, it was higher in the 60s, higher in the 80s, and then we became more of consumers in the 90s, I guess, and even in the 2000s. And then you see this massive spike during the pandemic when they gave out a bunch of money. So you see a massive spike in 2020, and then 2022 or 2021, whenever they gave the next check. And then you see personal savings rates drop below to a historical low, right? So the pandemic historical rates were at a massive high because the government gave out a bunch of money. And then everybody spent all that money, pushing asset prices up. And now personal savings rates are at a historical low when most people could not cover a vehicle emergency if it were to happen. So that's when consumers aren't spending money, that impacts the economy. And if they have no money to spend, that's going to impact the economy. So a couple things that I wanted to grab from the last Fed meeting. Jerome Powell talked about housing, and he talked about a few different things at the meeting, right? Let me just pull up some of my notes here. So the Fed meeting was November 7th, 2024. So this was right after the election. So a lot of people didn't even really pay attention to this or notice what's going on. Um, I don't know how many people watched the Fed meeting because the election was around the same time. But the Fed just met November 7th and they did a 25 basis point drop. So let me just read some remarks from the Fed. I'm going to give you a summary of the November 7th Fed meeting. Actually, let me just put this up here just so people know what I'm talking about. So this is the press release from the Fed. My boy Jerome Powell. Let's go. Yeah, good afternoon. So a summary of what Jerome talked about at this recent Fed meeting is the first thing, he explained how the Fed worked, right? He explained the core functions of the Fed and how their goal is to keep inflation low and employment at reasonable levels. So the Federal Reserve offers free classroom-ready online resources for educators. They offer professional development. So many of the 12 regional Federal Reserve banks provide in-person and online professional development opportunities for educators to enhance their knowledge in economics and personal finance. And then students can participate in internships and things like that. He talked about that, as he always does. And the board of governors is 7 members appointed for 14-year terms. It oversees the Federal Reserve System and sets policy direction. The Federal Reserve banks, there are 12 regional banks representing different geographic districts. They operate independently in many respects and carry out core functions like supervising commercial banks, enforcing consumer protection laws, and ensuring the safety of the nation's payment systems. The Federal Open Market Committee, composed of members from the Board of Governors and regional bank presidents, the FOMC sets monetary policy to promote maximum employment and price stability. So their goal is maximum employment and price stability. Their core functions are supervising and examining financial institutions, enforcing compliance with federal consumer protection and fair lending laws. So Dodd-Frank really changed a lot of the functions that the Fed performs, but they enforce compliance with federal consumer protection and fair lending laws. Lending, they do lending to depository institutions to ensure liquidity in the market. They distribute currencies and coins, operating electronic payment systems and clearing checks. And they act as the government's bank by maintaining the Treasury's transactions accounts and managing U.S. government securities. So now on what they actually talked about. So economic activity, Jerome Powell said, one second, recent indicators suggest that economic activity has been, crap, let me pull up my notes again. I just lost them. Here we go. So Powell said, economic activity, recent indicators suggest that economic activity has continued to expand at a solid pace, with GDP growth at an annual rate of 2.8% in the third quarter. So in the third quarter, the United States had 2.8% GDP growth. And then the labor market conditions remain solid, with payroll job gains averaging 104,000 per month over the past 3 months. The unemployment rate has edged down to 4.1% as of October. So the unemployment rate has went down, and we've maintained a strong job market with 104,000 per month over the past 3 months. Now, is that all government jobs? That's another question. Inflation has eased significantly from a peak of 7% to 2.1% as of September. Core inflation remains somewhat elevated at 2.7%. The FOMC decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25%, 4.25%. This recalibrated aim to maintain economic strength and further progress towards the 2% inflation goal. So their goal is to not have zero inflation, it's to get to 2%. And they dropped the Fed funds rate by 25 basis points on November 7th. Some of the things that were highlighted at this press conference, Chair Powell emphasized the importance of balancing the risks of moving too quickly or too slowly and adjusting monetary policy. And the economic strength, the economy is performing well with strong growth and a robust labor market despite global uncertainties. So this is all what Jerome Powell says. This is not me saying this. This is Jerome Powell saying this and reading from my notes. Inflation expectations, longer term inflation expectations remain well anchored, and the Federal Reserve is committed to preventing them from drifting upward. So what does that mean? So that's a really important statement. I'm just going to share with you my notes here so you can see, because I think this is a pretty important thing he said. So right now, the bond market is not agreeing with what Jerome Powell is saying, right? Jerome Powell is saying that inflation is under control. Now, he says longer-term inflation expectations remain well anchored, and the Federal Reserve is committed to preventing them from drifting upward. So right now, we talked about how mortgage rates are going up, even though the Fed is cutting rates. So the Fed also buys Treasury bonds. So the Fed is the largest holder of Treasury bonds. And so when the Fed wants to lower rates, they start buying up Treasury bonds. So the Fed can start any day buying up Treasury bonds, and that will artificially lower the interest rate on mortgages and bond yields. So, I wonder, I know that the Fed can jump in and do those types of things. So it's hard to say, what'll happen, right? But the Fed is committed to keeping interest rates and inflation down. I mean, not interest rates, but definitely inflation. So the Federal Reserve is independent, like they always talk about, and the fiscal policy. While acknowledging that the federal government's fiscal path is unsustainable in the long term, the Federal Reserve does not have oversight over fiscal policy. So Jerome Powell talked about how he was asked about the United States debt problem, and he basically said, like, yo, we can't do anything about that. That's up to Congress. And not us. We have no sight into that, is basically what he said. And then I just lost my spot. Commitment to dual mandates. So the Federal Reserve remains dedicated to achieving its dual mandate of maximum employment and stable prices. The focus is on supporting the economy's strength while bringing inflation sustainably back to the 2% target. Decisions will continue to be data-driven with careful consideration of the evolving economic landscape. So I believe that Jerome Powell has probably said those same things verbatim, basically every single meeting. So whether or not, that, I mean, that is their job, right? So now he had a couple remarks specifically on housing, and I wanted to get into that because he says some key things in here about housing. So when asked about housing, Jerome Powell basically said that there is weak activity. So Chair Powell noted that unlike other sectors showing solid growth, activity in the housing sector has been weak overall. The weakness contrasts with the strong performance seen in consumer spending and investment in equipment and intangibles. In contrast, activity in the housing sector has been weak overall. There has been an elevated housing services inflation. So during the press conference, Chair Powell elaborated on how housing services are impacting inflation measures. So housing is a massive percentage of the PCE. So he pointed out that housing services inflation remains higher than desired, which is affecting the overall core personal consumption expenditures inflation index. What's not back to desired levels is housing service. So let's talk about housing services. Housing services is higher, and that's a direct quote from Chair Powell. So the cause of elevated inflation in housing services, according to Chair Powell, is that there is a lag in lease adjustments. So Chair Powell basically explained that while market rents and newly signed leases are experiencing very low inflation, older leases that are turning over are taking several years to catch up to current market rates. So basically, you typically sign a year lease and the new leases are coming in lower, but it takes a while. There's a lag effect because someone has to move out basically. If you're renewing those leases, you're not going to see the price effect. Someone has to move out and a new resident has to be found. And also with all the construction that's hitting the market, in some markets, it's a very competitive rental market. So reflecting on past pressures, this lag is causing a catch-up effect, which is not reflecting current inflationary pressures, but rather past inflationary pressures. What's going on there? This is a direct quote. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older leases that are turning over are taking several years to catch up to where market leases are. It's not really reflecting current inflationary pressures, it's reflecting past inflationary pressures. So, what he's saying here is that a lot of people never raised rent. So, you know, the majority of landlords are mom and pop landlords that own under 14 properties. And a lot of mom and pop landlords did not keep up with rent increases through the pandemic, and rents were low. So now these properties are changing hands, or the landlord is finally increasing rent to the new market level. And we're seeing this go up now, but this is a past inflation thing, right? So the lease turnover from these rents that needed to be increased are still happening, but we're not getting a lot of rent growth from there. So impact on inflation outlook, the elevated inflation in housing services is expected to normalize over time as older leases adjust, contributing to the overall path toward the 2% inflation goal. This is a direct quote as well. We feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact. And monetary policy considerations related to housing. So, not a source of current inflationary pressures. The Federal Reserve recognizes that the current elevated inflation in housing services is not due to ongoing inflationary trends. Therefore, it is not seen as a significant source of inflationary pressure that would necessitate a change in the current monetary policy stance. So they're not going to keep going after housing. They're not going to try to drive housing into the dirt. They recognize that there's a massive lag effect in the housing sector. Policy stance. The Fed's approach takes into account the lag in housing services inflation by understanding that this is a temporary effect due to lease adjustments. The Fed can focus on maintaining overall economic strength while continuing efforts to reduce inflation. So, in summary, Chair Powell said that there's been weak housing sector activity. The housing sector is underperforming compared to other areas of the economy, showing overall weaknesses in the housing services inflation dynamics. So current market rents are experiencing very low inflation. We're not seeing a lot of rent increases on rents that are already maxed out, right? So if we maxed out rents in 2022, we're not getting much higher than that. But the leases that are from 2017, we can bring those leases up to 2022 levels. So this is causing inflation, but it's from past inflationary things. So implications for inflation and policy, the elevated inflation in housing services is temporary and a result of past pressures, not indicative of current inflation trends. The Federal Reserve expects this effect to diminish as leases adjust, helping to bring inflation down to the 2% target. The Fed is not adjusting monetary policy specifically in response to housing service inflation, as it understands the underlying causes are transitory. Conclusion. The Federal Reserve acknowledges the weakness in the housing sector and the temporary elevation in the housing services inflation due to lagging lease adjustments. By recognizing that this is a catch-up effect from past inflationary pressures, the Fed is maintaining its current policy trajectory, focusing on sustained economic growth and guiding overall inflation back to the 2% goal. Situation in the housing market is being monitored, but it is not currently prompting a change in monetary policy. So that's what Jerome Powell basically said back in November 5th. And yeah, so I'm going to open it up to questions. I see I have one here from TNT Capital Investments. What are treasury bonds? So treasury bonds are debt that the United States government issues to finance its operations. So what does that mean? That means that the government basically issues an IOU. It's like if I wanted to get money from you, I could say, "Hey, lend me money and I'm going to give you a bond and I'll pay you back over time." So a government is able to issue treasury bonds to finance the government. And a company can issue bonds as well. But basically, it's just debt. It's an IOU. You're buying. You need an investment. You need a return on your capital. So the treasury bonds might yield, 4.25% or whatever, and that's a good investment for you. So you think that the United States government will pay you back, so you're going to buy treasury bonds. So treasury bond is a debt vehicle used by governments and large corporations. Except in corporations, they're called corporate bonds. So I hope that answered your question there. And speaking of treasury bonds, like that is one of the things that affects the mortgage rates, right? So treasury bonds, even though the Fed has been lowering rates, treasury bonds are going up, right? So this means that investors aren't believing everything that Chair Powell says. They're kind of thinking that inflation is going to come back, just according to the treasury bond market. So I'm just logging into my brokerage account right now to pull up my bond watch list, because I meant to do this earlier when we were talking about the Fed funds rate. So this is just logging in and opening. So the like if you're an investor, right? If you have so they do that. So you buy yes. So the government issues treasury bonds when they need money. Yes. So you issue debt to be able to finance your operations. So that's the same thing with the government. And the Federal Reserve is the largest buyer for that debt. So the Federal Reserve holds more treasury bonds than any other government. China is in second, and then Japan, I believe. Let me just pull up this watch list. Okay, awesome. Let me see if I can share my screen here so you can see these treasury bond yields. So this is these are the current treasury bond yields. So TNX is the 10-year U.S. Treasury bond yield index on CBOE, and then FVX is the 5-year bond index on CBOE, and TYX is the 30-year bond index on CBOE. So the 10-year Treasury bond is what is most correlated with mortgages. Let's just pull up the chart here. I'm going to have to reshare my screen for you to see this chart. Why? Okay. Yes, the TNX index. There we go. Okay. So the TNX index, man, I wish I could just share this screen. Whatever. So you could see treasury bonds. So the Fed dropped rates in September, the middle of September, and you can see that rates, the 10-year bond yield fell massively before the Fed dropped rates. And then since the Fed has dropped rates, it's went up actually because all of the uncertainty in the Middle East and all the different uncertainty, investors are expecting inflation. So investors don't think inflation has went away. So they're demanding a higher real return, or they're demanding some type of real return. They're demanding a higher return so they actually get a real return. So a real return is like, you're getting 4%, but you're losing 2% because inflation's 2%. So your real return's 2%, right? I wish I could maximize this chart. So yeah, I mean, that's the 10-year. Let me see if I can share my screen on the chart for the 5-year. Because I mean, you can look at these bond yields and you could see what investors are thinking about the economy. So if bond yields are going up, it's because investors are demanding a higher return to hold that debt because they think the long down the road it might be rocky, right? So they want a higher return. Yeah, I don't know. It won't let me share my big charts, which sucks. But yeah, I mean, so it's so the 15 years is 41.80. So that means it's yielding 4.18%. The 5-year is yielding 4.76%, and the 30-year is yielding 4.336%. So this makes sense, right? Your short-term debt is going to yield the least because it's the least risky. And then your 10-year is a little bit higher than your short-term. And then 30 years out, you want a better return because that's even more risky because there's more unknowns the longer you go out, right? And the 5-year has went up. So, and this is saying that there's more demand for these bonds. And the 30-year has went down. So these are all things to monitor when you're trying to figure out what interest rates are going to do because they directly correlate with what investors will pay for mortgage-backed security. And so that's pretty much it. We talked about a lot of things today. I hope you got some value out of this. I am Jake Arnold. You can find me on social media on all platforms at The Real Jake Arnold. I talk about investing. I am a value investor. Our mission is to provide affordable housing in Northeast Pennsylvania. And when I say affordable housing, I mean housing that is relative to a wage that is affordable. So we like to have our rentals a little bit below market rent because one, it helps with our vacancy, but also it provides a more affordable place to live. So our goal is to get more efficient in our operations and to buy at better prices so that we can provide better housing for lower prices and create more value for the end consumer. So a lot of people, like Sam Waltman talks about, your margin is my opportunity. We see this in housing. That doesn't mean that we're going to buy deals that have no meat on them, but it does mean that we need to do a better job at buying deeper discounted properties, and we need to do a better job at construction to be able to get it done more efficiently to save money so that on the back end we could sell it at a lower price than what everyone else is selling it for. And we have less hold time that way. If we rent it, we have less vacancy. So at the end of the day, we're actually making more money while providing a better service. So a lot of people end up leaving Northeast Pennsylvania. We're committed to this area, and we want to see Northeast PA thrive again. And we think that you need good housing. There's a lot of distressed housing in this area, and we want to bring a lot of it back to life. You need jobs, you need good housing, you need good local amenities, and then you have a nice area to live. So we're working on the housing part, and that's what we can do for now, and that is our mission. And join me as I talk about our mission and I talk about our value investing position. We are value investors. We don't speculate. We buy good companies or I mean, good assets at good value. So that's what a value investor does, and we hold it for a long time. Now we do a lot of flips, but these flips are mostly to fund our buy and hold operations because we would like to be one of the largest housing providers on the East Coast, first and foremost, Northeast Pennsylvania. And that comes with the mission of making Scranton, Wilkes-Barre great again. So thank you for joining me and have a wonderful night. It's super cold up here, but we love it. So have a great night. Thank you for joining me.